Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. It is hard to believe that we are near year end and we have a very timely topic for you. Perhaps you have been hearing about the SALT cap deduction and state workarounds that we sometimes call the pass-through entity tax elections that we also call for short PET. So these have been gaining steam over the last year, and we have over 20 states that have adopted workarounds or PET elections, and we have had the IRS that has sanctioned guidance for these last November. So this has been gaining steam for the last year. And then it's also been reignited because we've had several proposals from the House and the Senate that have looked at how we modify the SALT cap deduction. So with all this swirling activity, that's created a lot of hot topics. And then you layer on top of that the whole question of what do you do and how do you handle this on your financial statements? So we have a lot of ground to cover today. We've got a great group of speakers and they're going to address all of the facets of this topic today. So I want to introduce Chris Hesse from our National Tax Office. Chris will give some background on the SALT cap and really how the IRS guidance is going to interplay with that. So welcome, Chris. Then we've got Dustin Hubbard, and Dustin is going to go into some of the specifics of just overview, how are these working on a state-by-state basis, and then some of the high tax states and just key guidance that we've been seeing and talk about that. And then finally, we've got Jeff Fitzgerald, and Jeff is in our National Accounting for Income Taxes group, and Jeff is going to bring this topic home, really wrapping it up and saying, if you make one of these elections, how do you handle that on your financial statements? So welcome to the three of you. We're thrilled to have you. So before we dive in today, we do have some housekeeping that we want to cover. We do have the ability today for live Q&A during our session. In order to participate, all you have to do is register using that link below me, and then you're going to be able to like and see those questions in order to move those up in priority so that we can best address them. And we have moderators that are standing by and they're ready to engage and interact with you. In addition to our live streams, we did want to let you know to continue to check our website for next year because we're already starting to put out content of all of the events that are out there that you can register for. Again, it's hard to believe that 2022 is on its way. And then lastly, be sure to just connect with your CLA advisor because we absolutely want to talk to you. So with that, let's get started. And Chris, I want to start with you. And I think as we dive into any of these topics, having some background to help frame the discussion is always helpful. So I think we've got to start with just a history of why these pass-through entity or PET elections came into being.
Yeah, thanks, Leslie. As many of you are aware, the Tax Cuts and Jobs Act instituted a $10,000 state tax deduction limitation, and we call that the SALT cap. That's for individuals. Individuals can't take state and local tax deductions greater than $10,000 as an itemized deduction. Quite a few states have responded to the federal $10,000 SALT cap by allowing pass-through entities, partnerships and S corporations, the option of calculating and paying the tax at the entity level. This also has attention because the $10,000 limitation would potentially be increased to $80,000. That's what has been going on through Congress over the last few weeks, although recently that's kind of been shut down. We'll have to see what happens after the end of the year. But the Senate negotiating its own version of the SALT cap adjustment, don't know where that's going to go. But it's quite possible that if enacted, these changes would be retroactive to tax years beginning in 2021, even if it passes next year, Leslie. So such changes could cause revisions or elimination of the SALT cap workaround in many of the states.
Yeah, that's really good background. I know you and I have just loved all the uncertainty we've been dealing with year over year as we deal with tax planning. So I think that's great background. And I know later when we get into some details, Dustin will talk about just all the different laws and all the nuances on a state-by-state basis. But having said that, I did mention at the outset that we did get some initial guidance on this topic really back last November 2020, Notice 2020-75. And there were some really key points in this notice. So maybe talk us through what those were.
Sure. Yeah. This notice told us that proposed regulations were on the way. The IRS was going to issue further guidance, first in proposed regulations, then IRS takes comments and makes a decision as to what the final regulation should be. But that was over a year ago. And while the guidance does indicate these elections for state and local income taxes imposed and paid by S corporations and partnerships on their income are allowed as a deduction in computing the partnership or the S corporation's non-separately stated income or loss. So what does all this mean? The guidance applies regardless of whether the tax is mandatory or elective. Most, if not all, of the state regimes are elective, and essentially avoids the SALT cap that is applicable to individuals because the deduction would be claimed at the entity level. And while the IRS's blessing of the pass-through entity tax workarounds was welcome news for many taxpayers and tax professionals, the notice is sparse on details and offers some surprising results as well. And we have to remember that this IRS notice was issued just after the 2020 elections by the Trump administration's Treasury Department. The Biden administration may not feel itself obligated to follow the concepts that were espoused in that notice, Leslie.
Yeah, I mean, I think that's all really good framework, just as we think about the fact that there's some gaps in that notice. It had some requirements in there that maybe don't make sense to us. And, we're still waiting for more guidance. We're waiting for those regulations, which are still taking time. So having said all that, you mentioned there's these requirements in there, some of which are kind of fuzzy. I think what would be good is to walk through what are those requirements that talk about what's required to take the deduction.
Fuzzy is right. The notice specifies that in order for the taxes to be deductible in 2021, they have to be paid. Payment needs to occur. The notice doesn't say paid or accrued. It clearly states that the PET must be actually paid. And this distinction is surprising since the notice treats the pass-through entity tax as an entity level election and deduction. We would have expected that the timing of the deduction follows the same rules with respect to state income tax payments of C corporations. That's what I would have expected. An accrual method partnership or S corporation should be able to accrue the liability as an accrual basis C corporation would accrue such a payment. But unfortunately, the notice did not reference the accrual method. It says paid. And it also generally important for taxpayers to establish that a deduction is fixed and determinable. Now, the notice didn't talk about that, but under general federal tax principles, a liability for a tax must be some liability that is fixed and determinable by the end of the year, fixed by the end of the year. And for the states with the elective PET regimes, this could be a problem because the election's generally made with the tax return that's going to be filed in 2022. And each state's regime, though, is unique to that jurisdiction, and some states require the election be made with the return, as I said. So if I'm filing for a 2021 calendar year return in 2022, making the election in connection with filing that return, there's a question as to whether there was a fixed and determinable liability in 2021 or by December 31 of 2021. In short, Leslie, the notice wasn't well thought out, very sparse, and the PET regimes of these various states, many of these states are kind of going on their own and relying on what other states had done and say, well, we'll design one for our own taxpayers, and they're listening to the lobbyists in saying what we should include in our particular state's regime.
Yeah, so I think you've clearly laid out the fact that there are some things that aren't thought through. I think that happens anytime guidance is issued. It sounds great on paper until you start to put things into practice. We find that all the time. And so, as you think through some of those issues that you've just pointed out, what do you think are some best practices for people so that they can put themselves in the best possible position to be able to avail themselves of this deduction?
Well, because the notice is sparse on details and provides some conflicting information from what we've known from the last 100 years of federal income tax principles, we want to take at least the taxpayers will have the best position that they can in order to establish the liability by the end of the year. And they should evaluate whether that particular state's regime is elective or mandatory. And if it's elective, it's suggested that the election be made prior to the end of the year, but some of the states don't have a mechanism for that. If the taxpayer decides to accrue taxes based on a formula, but pays the tax after the end of the year, the taxpayers needs to be aware of the position that could be challenged by the IRS, because this notice does say tax paid. And that could create some potential underpayment penalties then if from the mismatch of when the payment is occurring, Leslie.
Yeah, I think those are two really good pieces of advice, thinking through payment and thinking through timing of the election. So let's focus on the election piece here for just one moment. What if the elections are to be made with your tax return? So again, I pay the tax before the end of 2021, but I made the election on my 2021 return, and that happens in calendar year 2022 when I'm filing the return, because again, that's what the state mandates. Is there any good practices around maybe how I should lock in that deduction?
And we just don't have any guidance at this time, and the best thing is to raise our probability level, because that's what we're trying to do here, is to position ourselves for the highest probability that we can of sustaining this deduction that we're claiming for the payment of the tax. Is we're suggesting send a statement to the State Department of Revenue. Now, there's many of the states or don't have a mechanism for receiving these statements, but again, we suggest sending this statement of election to the Department of Revenue indicating that the taxpayer is electing the pass-through entity election prior to the end of the year. So get it in the mail by the 31st. There may not be support or merit in the state statute saying we can do that, but from a federal standpoint, indicating we are making this election that at least provides us with a better position than not doing anything. We're attempting to increase the probability of obtaining the deduction and having that deduction sustained if the IRS should review it.
Well, I think those were some really good points you helped unpack about really confusing issues about logistics, timing of the deduction. There's another one that comes up that I think we should address. It bubbles up really likely because the confusion in the drafting of the notice, and that is, can a deduction be claimed for state taxes that are imposed on non-trader business income?
Oh, again, this is just the IRS not really fully vetting out the issue when it issued this notice back in November of 2020. The IRS seemingly didn't recognize that there are different combinations of things that could appear on a pass-through entity's tax return: business income and deductions, investment income and deductions. The notice references the term specified income tax payment, which means any amount paid by a partnership or state or an S corporation to a state, political subdivision, or District of Columbia to satisfy its liability for income taxes imposed by the domestic jurisdiction on the partnership or S corporation. But it's a surprising result because it fails to recognize that a pass-through entity may not even be conducting a trader business. What if the partnership's an investment partnership? Then the taxes are not business expenses and shouldn't be deducted on page 1. But if we have a real estate partnership, we have to understand if it's a trade or business, where those tax expenses should be deducted. Classification of expenses should follow the income. And we shouldn't go so far as to take a position that there is a trade or business expense where we put the tax expense on page 1 of the return when that pass-through entity doesn't even have a trade or business activity in its entity.
Yeah, I think that's a really good clarification. That's definitely a trap for the unwary if you're not thinking that all the way through. So, Chris, thank you for that overview. We're going to pivot now and go to some state-specific nuances, and we're going to keep you around because I know there's lots of questions coming in. So let's welcome Dustin on. And Dustin, I think what we should do is really just start with an overview of the PET on a state-by-state basis.
Yeah, the easiest overview on that is that each state has its own regime. There's no way to do a simple, hey, here's the calculation or here's the methodology for each state, because they're all very different and very nuanced.
Yeah, I think that is a fantastic just approach and piece of advice, is that you can't just take a broad brush approach here. And so having stated that, Dustin, why don't you talk about just a few examples of the nuances that a taxpayer might have to consider when they're looking at pass-through entity elections?
Sure, I've got a bullet list that I can kind of walk through here, but I mean, you know, the first and I think the most important is how is the election made, and in one state, specifically Connecticut, it's mandatory. So the pass-through entity doesn't even have an option in that state. If it's active and doing business there, it has to make the election and pay the tax. But in most of the other states, it's an election that the entity can make. But even on top of that, once the entity makes the election, in some of the states, the owners themselves can then make their own election on whether or not they want to participate in that partnership or S Corp's election or not. I think the other thing that's important is, as Chris noted, is when should we make these elections? I would say in a lot of states, it is made with the partnership or S Corp's return when it's filed in 2022, which then has all of Chris's points and worries and risk associated with it. But there were some states, New York being the most notable, right around tax return filing season of October 15th, they said, if you want to make this election for 2021, you need to make the election by 10/15. So that's what we were doing around 10/15, along with filing a bunch of tax returns, was making New York elections for those companies or partnerships that it made sense on. The other way is, or another nuance is, how is this actually done in the return? So in some of these states, the flow-through entity will pay the tax. They will then flow through 100% of the income to the owners, and the owners will get some sort of a credit mechanism on their return associated with their share of the tax paid by the entity. In my home state of Colorado, we decided to do something very nuanced, and instead of doing that, we said deduct the partnership income off the owner's return. So there's a subtraction modification now on the owner's return, which comes with a whole gamut of issues and questions and things that you have to answer along those lines. Some states, then you start talking about tax credits for taxes paid and whether or not an entity level tax, which in theory, this is what we're trying to do, is create an entity level tax. Is that creditable in my resident state as an owner if it's not the same state that the pass-through entity is filing in? And again, that's not an easy answer across the board. Every state's a little bit different on when they will allow that and when they won't. And so I think that's a piece of it. And the final piece is the rate. I mean, like New York's got a variable rate. The rate in California is set, but it's set at a weird rate at 9.3, which is kind of in the middle of all the individual rates. And in some states, it's the exact same rate as the individual. So there's just a lot of nuances as you look across the 22 plus states that have this. And quite honestly, there will be more come springtime. So, yeah,
good overview. Lots of crazy nuances there. And so, one question that I think you probably get a lot of off the bat is that, given the background, it seems like a huge federal benefit to do this. So if you've got a multi-state pass-through entity, are they just making this election across the board on all their states? What are you guys seeing in the SALT group?
No. To be blunt about it, we're not. I mean, the complexities that we just talked about and the nuances when you've got a multi-state entity that is filing 5, 10, 15 states or more, and then you've got owners who are resident in another 5, 10, 15 states, you have to run the math on it, and you have to look at what the implications are going to be both at the state level and at the federal level for not just the entity, but the owners and each and every separate individual owner. And so you have to answer those questions and understand what is that really going to look like, and is there going to be an overall net benefit? Because in some of these cases, you pay a lot of extra tax to get a federal benefit, and it wipes out the federal benefit. So I think that's something to look at and weigh the cost benefit. The other piece of it that plays in here that we're seeing in a lot of states is, depending on the residency of those owners and where that entity is filing, you can have some serious winners and serious losers when it comes to the owners, and who gets the benefit and who doesn't. And how that plays out is an interesting conversation with an ownership group.
Yeah, so I think that's good, is that, the assumption might be, gosh, I'll just do it everywhere. Why wouldn't you do this? I think what you're seeing is, as you model this out, and modeling is the key, that maybe it's not as beneficial everywhere as you think. So you really do have to weigh the cost benefit. So having said that, what are the state income tax consequences when you make that pass-through entity election? And then what's the consequences to the owner?
Yeah, and that depends. I mean, as we've been talking about and beating that drum for a couple months now, you really, really have to model it out, and you really have to look at what's going on in the entity, in the states, and for each separate owner in order to fully vet out what the consequences are. And it's a fun conversation, because owners are coming to the entity saying, hey, this is what I'm calculating my benefit to be. And then you have to go back to them and say, well, the reality is your benefit is this. But you don't know that answer is until you model it out.
Yeah. So speaking of modeling it out, let's talk about a couple specific states.
Mm-hmm.
I think one that has probably been very popular is California, really for a couple of reasons. One is they just recently acted their pet election, and then, they're a high tax state. So a lot of people would maybe go, is this a slam dunk? But I think what you're seeing is that there's a lot of nuances in California. So talk to me a little bit about California.
Yeah. I think as we've modeled out more and more of the law, and we've gotten more guidance from the FTB, which it's still coming out. I mean, we got guidance yesterday on how you should treat trusts that are owners of pass-through entities. So that's all still coming out. But I think what we're finding in California is a nuance in the law there that you might run into in other states as well. We've seen with tentative minimum tax, or California's version of an AMT, the credit that the pass-through entity creates when it pays the tax is only allowed to offset regular tax. And so you have a lot of owners that have been paying regular tax on a profitable pass-through entity. That's all they've ever paid is the regular tax, and they think they're going to get full benefit of that credit. And what we're seeing in 95% of the cases probably is that regular tax gets lowered down to the 7% tentative minimum tax liability. And then you're capped. You don't get to use that credit anymore. So you're paying on the tentative minimum tax base and creating a credit carryover that you then have 5 years to use. And so there's planning around that can happen. But when you look at the cash tax numbers, or the cash paid this year, we're seeing some significant prepayments of California tax. And, for people that are planning into this, trying to get out of paying more California tax, that's not really the answer or the result that they're looking for.
Yeah, I mean, it sounds like if you don't do good modeling there, you could get into a position where you have a bad cost benefit situation, or just a bad time value of money situation. So I think that just highlights what you've talked about, and that's doing the modeling and making sure you approach this correctly.
Yep.
And so, having said that, another state that you have looked at that I think of as a high tax state is Minnesota, and it's got some really weird rules, several of which you guys are just getting more guidance around. And so talk to me a little bit about this one too.
Yeah, and Minnesota, and this is an example of the nuance that you really have to understand and look at on a state-by-state basis. But in Minnesota, in order to make the election, the bill states that one of the owners actually has to be limited by the SALT cap deduction before the entity can make the election. And it was thought that you had to actually have one owner be limited, and actually itemize their deductions. We got guidance last week that that's not the case. They don't actually have to be itemizing, but if they can prove that they're over the $10,000 limit, then the entity can make the election. But it's one more step, right, that a pass-through entity has to do, is they have to go to the owners and say, are you limited? Are you limited? Because they have to find at least one owner who is actually limited on that deduction. And so it's just a nuance. And if you miss that, you've created a fun web that you have to unwind somehow.
Well, that's just a crazy rule. So I appreciate you highlighting that. And I think all of your points here collectively really just highlight the complexity of these rules and really the need to understand which states have elections, how do you calculate the elections, how do they impact the owners ultimately, and then just modeling out those tax benefits to make sure it really is a good cost benefit. So thank you so much, and we're going to keep you around for questions. I also know you've got an awesome article that the whole SALT team worked together on for some state-by-state analysis summarizing these points, so thank you for that too. And with that, let's pivot to Jeff Fitzgerald and talk a little bit about the income tax accounting side of these. So Jeff, it's great to have you. And I know you've been doing a lot of work just on how these taxes could create impacts on financial statements. So I know you wrote an article on this. Frankly, I think there's a lot of people that totally have their blinders on. They're going to be shocked that this could even be an issue. So let's start with, what are the objectives of accounting for income taxes, just to set the stage for how these could possibly even come into the purview of financial accounting?
Yeah, thanks, Liz. You're exactly right. I think we're going to find some surprises as we have our discussion. So ASC 740 under US GAAP addresses how entities account for taxes based on income. Taxes based on income can cast a wide net and includes tax based on a measure of an entity's revenue or gains minus or less meaningful expenses or losses. So ASC 740 applies to the accounting for all taxes imposed on an entity by a tax authority that are based on the entity's net income. This generally includes, your U.S. jurisdiction, right? We have provisions and for foreign jurisdictions. We have to consider our state jurisdictions and even local tax jurisdictions. And the goal is really two-pronged of ASC 740. The first prong is to recognize taxes payable or refundable for the year or your current taxes. And then the second prong is to recognize deferred tax liabilities and assets for the future tax consequences of events that have already occurred.
Yeah, so that, I think that's just a helpful background to kind of set the stage here. So now that we've talked about that, and Chris gave us an introduction just about pass-through entity taxation in general, bring it together for us and explain how pass-through entity taxes might be viewed for financial reporting purposes. Yeah,
and I'm going to continue to beat the drum. The whole theme of today is it's not always clear, right? There's a couple of possible outcomes that we've been thinking through and where this could fit into. So the first is, management may need to consider whether these pass-through entity taxes are being viewed as paid or withheld on behalf of the owners. There's implementation guidance within ASC 740 that states that certain taxes paid or withheld on behalf of owners are considered transactions with those owners and should therefore be accounted for within equity. Because most of these tax regimes are permitting credits or exclusions to pass through to the owners to avoid the double tax, this guidance may apply. And in consequence, we could end up with a disparity where, for financial reporting purposes, these taxes are accounted as transaction with owners and recorded through equity. But in your tax return, we're recording a deduction against federal taxable income, right? We have to consider the classification of where that ends up. But if we're ultimately driving at a deduction, there's a difference between how we're reporting for this in our financial statements and what we're doing in our tax return. On the other hand, Chris talked earlier about specific language within the notice where specified income tax payments were defined. And they were defined as any amount paid by the entity, the pass-through entity, to a jurisdiction to satisfy that entity's liability for the tax imposed by that jurisdiction. Now, reading that language, it would appear to indicate that in order for the tax to be deductible, the tax must be an entity or must be a liability of the entity itself. and therefore be accounted for as tax expense within the scope of ASC 740 as opposed to an equity transaction?
Well, I think what you just highlighted here again is just how complicated this issue is. So thanks for that. It's clearly not straightforward. We could have two varying treatments, probably depending on what type of pet we're dealing with. So let's just assume for a second we go down the path that the taxing jurisdiction's pass-through entity tax ends up within the scope of ASC 740. So we have to account for the taxes. And then let's also pretend that it's deemed material for the financial statements. So now what do we do?
Yeah, and again, more questions than answers here, but it's complicated, right? So again, if it's determined to be a tax based on income and it's material, management needs to consider what we just talked about. It's in scope of ASC 740. They need to consider current taxes and deferred taxes to be recognized within the financial statements. But there's a complicating factor, which is when do we account for this, right? So the timing of recognition and measurement could be impacted based on several factors, and we've talked about some of these. But for example, is the tax mandatory like Connecticut, or is it elective like a lot of the other taxes that we're seeing? If the tax is mandatory, it's a little bit more straightforward because the tax effect should be recognized in the period that includes the enactment date, and then deferred taxes recognized would be measured at the enacted rates at which they're expected to reverse. However, if it's elective, questions to consider might be, for what period of time is it enacted or effective? Are there requirements for approvals to make or even revoke the election? So are we binding ourselves here in any way? And then if you don't have to make the election until you're filing your return, again, which could be 8 or 10 months after the financial reporting period, questions arise as the appropriate timing of recognition in those instances. So if the election is only annual, which is, again, what we're seeing as commonplace, do we need to recognize deferred taxes? In other words, do entities need to account for the tax when management has developed its intent and ability and can support making this election, not only for the current year, but for future years? Or are we looking at this as, hey, we should only be accounting for this strictly in the period when the election is filed for the time of period that is contained within each filing, right? So typically 1 year. Other things to think about, which we touched on, but will have financial statement considerations, would be some of these tax regimes, right, are only in effect when the entity is in an income position and not in a loss position. So we're flipping in and out of the tax. Right. Dustin talked a little bit about entities prepaying or making prepayments before these taxes are effective, or even under what we just discussed, when you might even account for these. So what do we do in those instances? Dustin also talked about California, where, right, they're computing the tax based on only the owners that actually elect to be subject to the tax. So then, right, what do you do in those instances? And then there's, right, other jurisdictions that are permitting loss carry forwards, credit carry forwards. And then do we have an issue where we need to assess those deferred tax assets for realizability? So now do we have VA considerations in those instances that can just create, a snowball of complexity. So lots of stuff to think about here. Not one clear cut answer, can't do broad strokes. It's very nuanced.
Yeah, I mean, you've certainly highlighted here a ton of great points. Just like making the election is complicated, evaluating that state by state, I think once you make one, now you've got to go through and evaluate all these different factors and determine, do I need to record something? And if so, how? So I think those are really good points. And I know you've also got an article out there that people can refer to as they're dealing with that. So what I want to do now is, we've gotten a lot of questions from the audience, and I want to take some of those here. Bringing back everybody. And the first one that I want to take relates to just character of income. So Chris, we talked about this issue, and we talked about the fact that there was some language in the notice that was perhaps bad wording, but it talked about this non-separately stated income wording in the IRS. And so then, how do you apply that to rental real estate or other rental activities? And I know you touched on that, but I think it's worth highlighting again, potential tracing and what we might have to think through there.
Yeah, and the first point, Leslie, that I would just caution people on is that we don't need to make these decisions today. we can wait until it's time to actually file the tax return, whether that be on March 15th or extend the tax return to September 15th, so that we have as much information available to us as we can, that we don't lock ourselves into a position, or we don't waste a lot of time. If the IRS sends out this information, then we'll have our answer. But just throwing out some ideas, I do think that the character of the payment really should follow the character of the income. And so if it's rental, I would put it on the 8825, the rental form for the pass-through entity. That's just what I would do today if somebody put a gun to my head and say, give me an answer. But again, it's not something that we have to decide today.
Yeah, so I think that's really good advice. And so this one may follow then with exactly what you just talked about, Chris. And so your answer might be, don't decide that today. But it's a question about investment partnerships that generate interest, dividends, capital gains, no business income. Do you think the deductions available for these entities? And so we talked about, character tracing earlier. And so what's your thoughts on that?
And that just adds another dynamic, because in my mind, the pass-through entity tax should be akin to how this entity would look if it were a C corporation. And a C corporation would be deducting that tax against the investment income. We wouldn't separately be stating it. But then the states have these regimes of giving the person a tax credit for the amount of the tax paid. And so I really don't know how to analyze that with what we know of general federal tax principles as to what we should be doing here. It's just not something that I mean, we can speculate all we can, but that would be just just speculation.
Right. I know we really need regulations and more guidance. So I think, one phrase we've been saying all along is extend as your friend. And I think that's going to be really important here.
Yeah, I agree.
So we do have another question, and this one I think is going to be a hybrid for both Chris and for Dustin to take. And that is if we extend a pass-through entity return, and again, we're telling people extending is a good idea here, so we really get this right, and hopefully get more guidance. A lot of times you don't know exactly how much tax needs to be paid. And so you might have people that estimate it at year end and then they have to pay more. And so in that instance, are we seeing underpayment penalties then when the filing's done? And, can they then subsequently take a deduction on the personal return? So I think, one question is the underpayment on the state return. And then the next question is, if you have to make an additional payment when you go to file, how do you handle that on the personal return, which might get to the timing of the payment that we talked about earlier, Chris?
So I'll give it my shot as to the notice says the amount paid. So we have the amount paid. We're going to put that on the 2021 return if we pay it before the end of the year. And if there's a balance due, very well may be that balance due, because it's now paid in 2022, will just be a deduction in the 2022 year. Absent any further guidance from the IRS, that seems to be what the notice is saying. I'll let Dustin, though, address the issues of underpayment penalties and what happens if there's an overpayment, underpayment situation.
Yeah, and I think the overpayment, underpayment situation, I mean, that's a little bit fluid right now. I would, like Chris talked about, I would anticipate it looking a lot like a C Corp, right? Where if you're underpaid, you're going to have some penalties and interest due. If you're overpaid, then the pass-through entity is going to get a refund. Because the goal, as we've been talking about, is to make these entity level taxes legally imposed on the entity as opposed to the owners. That's the goal. So that's why I'm speculating, to use Chris's word, that's how that would work. We haven't seen, in a lot of states, we haven't seen forms even yet. And so it's hard for me to say exactly how that's going to work. The other thing that I would caution you about is make sure you double check when those payments are due from a state perspective, right? We're saying pay it by 12/31 to get the deduction on the 2021 return. But like California, there's no penalties and interest as long as you're paid in by the filing of the March 15th, the original due date of the return. Massachusetts, there's no penalties and interest if you've paid in by January 15th. Why January 15th? I don't really know, right? I mean, just let's pick a date. I mean, I made the comment about spinning around 30 times and throwing a dart at the wall yesterday, and I think that applies for that date that they picked there. But I think those are understanding in each state how that's going to apply and what that deadline is to get a payment in, especially for 2021, where these things were passed partway through the year and states are giving you a little bit of leeway on when those 2021 payments are due. And then you got to double check 2022, because now in most of these states, the 2022 taxes are going to be due quarterly, just like they would be if you were a corporation. And so you may end up paying 2022 taxes before you end up paying 2021, assuming you don't make the payment by 12/31.
Yeah, so lots to think about, and part of it impacts penalties and interest on the state side. Part of it impacts when do I lock in my federal deduction, and those two really need to go hand in hand. So thanks for tag teaming that. All right, another question I want to take is, we've talked about the fact that 20 some states have given guidance. There's probably going to be more coming. So where can people find specific rules for each state?
Yeah, I mean, the article that we have out on the website for CLA is going to be high level. It's not going to get into all of the details and all of the nuances. That's almost impossible to do for each and every state. The best resource is going to be a state Department of Revenue website. There's going to be, in most of them, there's an entire page just dedicated to this, along with an entire FAQ page dedicated to this. And those pages will typically link you to the law, and then digging into the law and understanding what that law is actually saying, because we all interpret it a little bit differently.
Yeah, I think that's good advice. And then I think even just consulting with an advisor, making sure you interpret that right and modeling that out afterwards to make sure you have the best impact is important there. So I think that's fantastic. Well, we are at time, and we really appreciate everybody's participation today. I want to thank our speakers who have been with us for all of their advice on this matter, really attacking it from all the different facets. I want to thank our moderators who've been live with us, and I want to thank all of you for your engagement and your questions. So we encourage you to register, continue to engage with us. We absolutely love having you be part of the conversation, and we're going to see you in the new year. But until then, stay safe and healthy and have a wonderful holiday. Thank you so much.
Happy New Year. Bye-bye.